Hi friends, finally some smile and good news is starting to come out from rating agencies. For example, Goldman Sachs is now saying that Nifty has a potential to go up by around 14% by 2026 and they have become overweight, meaning they are bullish about Indian stock market in 2026. And not just Goldman Sachs, it's also Morgan Stanley and HSBC who have joined the party and have released quite a few bullish reports about Indian stock market. And if you look at the 5 simple reasons why Indian stock market could deliver better returns in 2026 as per these rating agencies, these 5 reasons are: number 1 is the policy pivot, which is around GST and income tax cuts, which is likely to boost the consumption. Second is earning cycles. Because of these consumption boosts, it is entirely possible that by 2026 we see mid-teen growth in our earnings. It could go up to 14 to 15% thanks to financials, consumers and autos. Factor number 3 is FIs. So we all know that FIs have been selling Indian equities, and there is an estimate that in the last 12 months they have sold to the tune of $30 billion of Indian equities. And it is entirely possible that majority of this money has gone to AI driven themes, for example in Korea, Taiwan, or in fact in US stock market. And there is a narrative right now in the market that AI rally might cool down, or it's already cooling down. Therefore, it is entirely possible that FIs might start coming back to Indian stock market very soon. Fourth is the valuation. If you look at the valuations, as of now, Nifty is at around 22 PE, which is pretty much the long-term PE. If you go back to 10 years of data, you'll find Nifty to be around 21, 22, not more than that from a long-term average perspective. So valuations are not like crazy. It's not like Nifty is trading at a 26 or 27 PE. That also gives some level of comfort. And final point is the self-help bull market, which essentially means that the domestic inflows, which is SIPs done by retail investors, people like you and me who are investing in stock market, that has kept very good liquidity when it comes to domestic flows. Therefore, that is also likely to help. Now, whether these predictions will come true or not, time will only tell. But definitely what I am able to see here is that the sentiments about Indian stock market is slightly being lifted now, and hopefully in the next 1 to 2 quarters we might see some good action in Indian stock market. Having said that, what I'm going to do in the rest of this video is speak about 3 stocks where I see good fundamental growth in the last few quarters, and also I will present you some latest and greatest about these 3 companies so that you understand about these companies. Again, it's not a buy or sell call here, but these 3 companies, at least you will get some insights in terms of what's happening at fundamental level, valuations level, so that you become a better informed investor. With that, let me get this video cracking. The first company that I would like to discuss is Oriana Power. We all know Oriana Power is into renewable energy, and this company operates into 4 main segments, which is solar, battery energy, green hydrogen and compressed biogas, right? Again, I've talked about Oriana on my channel previously as well and have given you deep insights about this particular company. But coming to their recent performance, if you look at the last couple of years, the top line of the company has grown at around 170% CAGR basis. And if you look at the PAT, it has grown at around 287% of CAGR basis. Huge improvement in the EBITDA margins. As you see, the margins have expanded. FY25, it has went up to 24.86%. And if you look at the debt to equity, that has been consistently coming down. So overall, last 2 to 3 years of fundamentals have been very, very good. Now, if you look at the latest results they published in Q2, so if I combine Q1 and Q2 FY26 results, if you look at their revenues grown by around 2.17 times. If you look at their PAT, grown by around 2.5 times. So overall, from a top line and from a profitability perspective, very, very good set of numbers that have come out in H1 of FY26. Also, if you look at the cash flow statement of this company, very clearly the cash equivalent at the end of FY26 H1 has almost doubled from 60 crores to almost 117 crores. Although operationally they have generated less cash in the H1, but overall the cash position is very, very comfortable. Now, what about the future outlook of this company from a fundamental perspective? So I will just talk about 3 key highlights of the fundamental improvements or development that have been happening in this particular company. Number 1 is that they've signed a MOU with a Canadian company, and this company, as of now, the MOU is only $300 to $500 million, but has a potential to go up to $1 billion over 5 years. So this is some huge investment, right? Second one is that they have signed a joint development agreement with Actis GP LLP for development of RE projects, which is renewable energy projects. And this company is pumping around $100 million in the next couple of years. So that is also very, very good development in my view. Third one is the green hydrogen and green ammonia. So SECI, which is a government independent agency in India, that has given them around 60,000 MTPA green ammonia and 10,000 MTPA green hydrogen allocation. This is very, very good. It's going to generate annual recurring revenue. As you can see, management is saying around 313 crores going forward. So these three are good development. These are very futuristic and positive development in my view. If you don't understand about green hydrogen, green ammonia, in fact, I did a podcast with their MD, which is Mr. Rupal Gupta. It's on the channel. Go and listen to him. You will learn a lot about renewable energy. By the way, this is not a push that you go and invest in this company, and a full disclosure that I am an investor in this company. I already invested in this company a few months back. Here, the intention is for you to understand what's happening in upcoming spaces like green hydrogen, green ammonia. Therefore, if you watch this particular podcast, you're going to learn something or the new. Now, if you look at the valuations of Oriana Power, as of now, if you look at the PE ratio, it has been contracting mainly because their EPS has been growing very, very high at a good healthy rate, and therefore the PE ratio is coming down. If you look at, for example, right now it is at around 22.6. Median PE in the last, let's say 3 years or 2 years have been around 34. So it's well below median PE. If you look at the price to book ratio as well, it's well below median. So it is at around 8.2 right now. The median has been around 15 if you look at the last couple of years. If you look at the EV multiples, that also is below median. It used to be around 34.5 and here it is at around 15.1. It's a SME stock. These stocks are very, very volatile in nature. Therefore, you have to be really very, very aggressive investor if you ever want to consider SME stocks, right? But this few minutes commentary hopefully encourages you to go and explore this particular company. It's one of the fast growing company in the renewable energy sector. Generally, I keep talking about such companies and insights about markets, stocks, mutual funds, ETFs, etc. on my YouTube community as well. If you're not yet a member, want to join, simply go to my channel, find the join button and be my guest. The feedback of this community has been excellent. I try to post almost on a daily basis so that you can learn practically in terms of what's happening in the market. With that, let me now move to stock number 2. The second stock that I'm going to discuss with you is PV Fintech, which is Policybazaar plus Paisabazaar. Now, if you look at these companies, last 4 to 5 years of fundamental progress, very, very good solid business, 39% of CAGR growth rate in the insurance premium. So insurance side, which is Policybazaar, and disbursals, which is the Paisabazaar, the lending side of the business, around 41% of CAGR there in terms of disbursal. So this is a good growth rate in my view. But if you look at the overall Q2 results that have just come out, very, very phenomenal growth rate there as well. Revenue grew at around 38% and mind you, the margins have improved. If I talk about the PAT has grown at around 214% year on year to 220 crores. These are some phenomenal growth numbers that are coming from Policybazaar. Now, if you look at the overall business as well, how that has transitioned from a loss-making business. So if you go back to Q2 of FY22, their PAT margins were minus 73% to now 8% positive. So they have turned from a negative loss-making company to positive because of course initial years of the company there was a huge investment in the company in terms of the platform, everything, but now it has turned positive. And not only it has turned positive, it is now increasing its PAT margins, which is very, very encouraging in my view. Now, the reason I am also speaking about this particular stock is because of the changes in the GST. We all know now that health insurance and life insurance is now exempted from GST. Now, the question is that if that is the case, what is likely to happen to the insurance premium growth rate? So my thesis is that number one, if the premium has come down because of the GST reduction, then more people are likely to sign up for insurance. It becomes more affordable to people. That's the entire intention of Indian government, that let's remove the GST. Therefore, more and more people can buy insurance, right? So that's number one. Number two is even what their management is saying. Let's say I am an existing policy holder and when I go to renew my policy, because the GST has been removed now, my premium should fall down. But what could happen here, which is what exactly the insurance platforms or companies would do, is that they will also offer you another option that instead of reducing your premium, why don't you go for higher sum assured? So for example, from 1 crore term insurance to 1.5 crore, that is only going to cost you 100 rupees monthly extra, right? So it is entirely possible that because of the GST reduction, people have more money in their pockets and they might buy higher insurance ticket items. That is something that PB Fintech's management is saying. So again, In my view, GST is a tailwind as of now. Of course, the collection of insurance premium might get reduced, but overall profitability should not take a hit here. Now, coming to PB Fintech, you might have a very, very good question to me that Rahul, if you look at this stock, the PE of this stock is even this reduction of the PE is now at around 180. Isn't this a crazy PE? So whenever you're looking at a stock which is trading at a very, very high PE, you need to do some advanced exercise. Let me quickly show you how to do it, taking PB Fintech as an example. This is something very advanced, so if you don't understand it, watch it a couple of times and I'm sure you will understand it. I'll try to simplify it as much as I can. So what you see on my screen is as of September 2025, we look at the last 1 year, which is the 12 month of data. How much of premium they are collecting? 27,386 crores, right? And if you look at the PAT, which is percentage of this premium, is 1.7%. And if you look at the PAT, which is 461 crores. The question you need to ask yourself is that current PE, which is 180, right? It is reflecting the net profit of 461. Why? Because PE ratio is what? Trading price divided by the earning per share. Earning per share comes from the net profits, right? So very, very simple. 461 crore is the profit. Therefore, the earning per share is how much? Let's go back and have a look at this earning per share. It is right now 10 rupees, right? Therefore, the PE is very high. Now, if this earning per share can go multiple times, can grow to let's say 50, 60, 70, then all of a sudden this PE will compress given the current price that we have today. So now what I did was I was reading their management commentary and looking at their guidance. So the management is guiding for 1 trillion premium number. Okay. And they're saying that this PAT percentage is going to be around 3%. That's what they're targeting. So if I do some maths and if I just say that rather than 27,000, sometime in future, they are going to get to 1 lakh, right? 1 lakh crores of premium. And if I do some maths, 3% of this particular premium, which comes out to be 3,000 crores of PAT. So it is entirely possible that the management is able to hit these guidance. If they're able to hit these guidance, their PAT can go from 461 crores to 3,000 crores, right? That comes out to be around 7 times. Meaning that if I take a very broad scenario, again, these are very broad calculations, the current EPS, which is at 10, it can go up by around 7 times. Again, assuming that number of shares remains same. So if let's say this shoot up to 70, okay, the EPS, and if you look at the current price, which is around 1800, you divide the current price by the forward EPS. So we are talking about the forward EPS here, okay? And if you divide that, it comes out to be around 25. Meaning if the company hits the targets of 1 trillion premium and if their PAT as a percentage of this premium comes to be 3% sometime in future, we don't know when that will happen, but sometime in future, then at the current price, the PE will not be 180. It will come down to 25. As you can see, the PE has been coming down. So if I just go back to this chart, why is this PE shrinking? The PE is shrinking mainly because the EPS is growing at a very, very good growth rate. Therefore, the PE is coming down. And this entire narrative about this 180 PE should disappear provided the company can continue to grow their EPS. I've given you these numbers as well. These are not made up numbers. This is what the management is talking about, given you the commentary. Hope this helps you. And the entire reason of me explaining this scenario is so that you understand the advanced investing, which is to look at the forward EPS. You look at the management guidance. Don't just look at the current PE. Look at the forward PE, and this is how you can make some valuation related decisions. Again, not a recommendation here that you go and invest in any of these companies, but I'm practically teaching you, giving you latest and greatest. And if you're liking that, request you to hit the like button. Let me know in the comments. Simple thank you. It motivates me to do a lot of work for you at zero cost. With that, let's move to stock number 3 now. Third company that I would like to discuss is from banking sector, a company called Bank of Maharashtra. All of us are aware of Bank of Maharashtra. One very, very interesting point that I noted about Bank of Maharashtra is that if you go to their P&L account and look at the compounded profit growth rate versus stock price CAGR, there's a complete misalignment. 10 years profit growth rate 28%, 5 years 70%, 3 years 69%, trailing 12 month 24%. And look at the respective numbers in terms of the stock price CAGR. There's a big misalignment is what we can clearly see. Point number 2 about this particular company is that if you go into investor sections, what you note is that the promoters, which is the Indian government, has the 79.60% stake. It should come down below 75%. I hope it should be done soon. But the FIs and DIs have very low stake as of now. And because the promoters hold around 79% of the stock, there is very little free float in the market. Therefore, that is always good from a price perspective. These are the 2 critical points that we need to understand. And if I also talk about the valuation, so if I go and have a look at the valuations, PEG ratio of this bank is the lowest. It is 0.11 if you compare with all other PSUs. Mind you, I'm not saying that all other PSU banks are bad, but Bank of Maharashtra clearly is showing you the PEG ratio which is the lowest. Lower the PEG ratio, better it is. Why? Because PEG ratio is simply what? PE ratio divided by the growth rate. So it means that if the PEG ratio is lower, it means the growth rate is very high given the price earning multiples, right? So again, coming back to the valuations, if you look at the PE multiple 7.41 versus industry of 7.95, not hugely overvalued. In fact, it is fairly trading there. And from a PB perspective, price to book 1.44 versus 1.17, slightly overvalued. But again, coming back to the fundamentals of this company, let me now quickly speak about the latest results that have come out. Point number one is that if you look at the net profit of this company in Q2 of FY26, it's gone up by 23%. Tell me how many banks you know. Maybe this is homework for you. Go and check how many banks have declared Q2 FY26 results and their profit growth rate. This bank has delivered 23%. In my view, you won't find more than 5 banks that have delivered 23% of profit growth rate. Of course, this is a smaller bank as compared to likes of SBI, HDFC, ICICI. But still, even if you look at mid or small cap stocks, you won't find a lot of stocks that have delivered good profit growth rate of around 23%. If you look at the NPAs as well, have come down. Gross NPAs massively have come down. Net NPAs have come down. And I also checked their P&L account. They haven't made huge provisions or less provisions. Very, very similar provisions is what I've seen from a pattern perspective. Now, what is driving this growth rate? One of the factors I could spot in their loan book is that retail sector, which is the retail loan book size, has grown at 37%, which is very, very good growth rate. And that is where the growth is coming from. Why is this growth coming from retail sector? When I was reading their management commentary, what the management was saying is that they have a 5-year plan to open 1,000 branches. And in FY26, their projection is 321 branches. They in fact are calling this as Project 321. So they are opening a lot of branches, and as a result of which they are able to grow their retail banking is what I could link or connect these two dots here. If you look at another important parameter which the management was talking about is the GIFT IBU. So in the GIFT city, they are opening a branch to facilitate the international payments, and for which the expectation is that in the next 12 months, that loan book also can grow to around $1 billion, which is a significant amount in just 12 months of time period. So overall, from a fundamental perspective, it is looking very, very good. I don't see any major red flags here from fundamentals perspective. Of course, I can't predict the next few quarters in terms of what their names will be, what their NPAs will be for that matter. So we can't really predict it. But as of now, valuations looks very good to me. And the fundamental growth also looks very good to me. Again, a full disclosure, this bank I had added few months back in my portfolio. So it's that I'm sharing it very, very honestly and openly with you. Again, go and do some research about these companies so that you can also do some research, learn what is happening fundamentally, what is changing. I've only scratched the surface here. I haven't gone deep into what's happening, because if I were to do that, one single stock will take one video and that might go to 30 to 40 minutes. So therefore, that much of time is not there. So I've summarized few key highlights for you to now go and do some further study at your end. If you like this video, request you to hit the like button. Let me know in the comments. Simple. Thank you. I look forward to see you in my next video. Until then, keep rocking.